Hi everyone. In this video we're going to be looking at one more example on calculating the overhead variances, and then we're going to use those variances to make our journal entries for our overhead in standard costing. Here's the example we'll be using. The Maria Company uses standard costing in its manufacturing plant for auto parts. The standard cost of a particular auto part, based on a denominator level of 4,000 output units per year, included 6 machine hours of variable overhead at $8 per hour and 6 machine hours of fixed overhead at $15 per hour. Actual output produced was 4,400 units. Variable overhead incurred was $245,000. Fixed overhead incurred was $373,000. Actual machine hours were $28,400. We need to compute all of the overhead variances, including the variable and the fixed overhead variances. So what I'd like for you to do is click pause on your player now, and I'd like for you to attempt to calculate the variable and the fixed overhead variances and also calculate your total overhead variances, and then come back and we'll take a look at them together. So the first thing we need to do is draw all the charts and label everything. So for overhead we have 3 different charts. We have charts for variable, our chart for fixed, and then our total overhead chart. So we're going to start with variable, and the first peg is our actual variable cost. So sometimes we may have to calculate this number, sometimes we may be given actual variable cost. In this case, we were given actual variable cost, and they tell us in the story that it was $245,000. The middle peg is actual quantity times standard price. They don't give us this number, so we're going to have to calculate it. So now we have to be thinking about what is driving my overhead cost, because that is quantity when we're talking about overhead, is the cost driver. In this case, it is machine hours. So we're looking for actual quantity of machine hours. They tell us that in the story. Actual machine hours were $28,400. Okay, so $28,400. I need the price that I should have paid per machine hour, and they tell us that it included 6 machine hours of variable overhead at $8 per hour. So we should have paid $8 per hour. So that middle peg comes out to be $227,200. And the last peg is standard quantity times standard price. What should have happened at the actual level of production is how we've been defining standard quantity. So what is my actual level of production? They tell us in the story the actual output produced was 4,400 units. So 4,400 is the actual level of production. What should have happened, so how many machine hours should we have used per unit? In this case, they tell us it was 6 machine hours that should have been used. And the standard price we're just pulling from the middle peg, because we already found that was $8. So this last peg is $211,200. So now we can calculate our variances for our variable overhead. So the difference in pegs 1 and 2 for variable overhead is $17,800. The only difference in the 2 equations, because we need to determine if it's unfavorable or favorable, so we're just looking at the equations here. The only difference is price. So if, in this case, the actual cost was higher in total than the middle peg, so that must mean the actual price was higher than the standard price, so that's not a good thing. So that will be an unfavorable variance. The efficiency variance, that's the difference in pegs 2 and 3, and that is $16,000. And the only difference in those equations is quantity. So 4,400 times 6 is less than 28,400. So that gives us another unfavorable variance for efficiency, meaning that we used more machine hours than we should have. So now we can turn our attention to fixed overhead. They tell us in the story that actual fixed overhead was $373,000. They tell us that budgeted fixed overhead is based on a $15 per hour rate. So we know that part. So I can go ahead and put that in both of my last pegs here. So I got that standard price, but I don't know a quantity for this budgeted piece. I need my budgeted machine hours. They tell us that it's based on a denominator level, so we know anytime we see that word denominator level or normal volume or expected capacity, it's going to show up in one place in all of this peg system we've been talking about, and it's right here. This is the only place you're going to use that normal volume or that denominator level, is to find that quantity right there. Okay, so they tell us that it's based on 4,000 units per year, and we know we're supposed to use, or budgeted to use, 6 hours. So that would be our budgeted quantity of hours, so 24,000 times $15 gives us a budgeted fixed cost of $360,000. And our last peg, we've already calculated standard quantity for overhead. Whatever you calculated for standard quantity for one of the overhead pieces, it will also be the overhead or the standard quantity for the other overhead piece. So it's still 4,400 times 6 hours. And that gives us an allocated or fixed standard cost of $396,000. Now we can calculate our variances for fixed overhead. The difference in pegs 1 and 2, we can calculate that at 13,000, and actual costs are higher than budgeted, not a good thing, so that's unfavorable. The difference in pegs 2 and 3, we calculate that at $36,000. And now we need to determine if this is favorable or unfavorable. So what we need to look at here is production level. That's what we can focus on. So if we do that, we focus on these numbers right here. Okay? So it looks like we actually produced more 4,400 times 6 than we thought we would 4,000 times 6. So that's a good thing. So production level is higher than we thought it would be. So that's going to be a favorable variance there. Now we can calculate our total overhead variances. The first one is our spending variance. So we're just going to add up all of our spending variances. We happen to have 2 of them right here. Okay, so we're going to take that one plus that one. It's going to equal our total. Since they're the same sign, meaning they're both unfavorable, we can simply add them together. When you do that, you get 30,800, and that is unfavorable. Just bring the sign down. If you look at our 4 variances for overhead, we only have one efficiency variance, and it's found in the variable variances. So we're just going to bring that variance down here, and that was 16,000 unfavorable. And we only had one production volume variance. It was found in the fixed overhead, so we're going to just bring that one down, 36,000 favorable. Now we can calculate our flexible budget variance for overhead. Since they're both, spending and efficiency are both unfavorable, the same sign, we can simply add those together, and we get 46,800 unfavorable. Then we can get our total overhead variance, and that's simply adding the 3 variances, our total spending, efficiency, and production volume variance together, summing those if they're the same sign. But in this case, one of them is different. Or you can sum the flexible budget variance and the production volume variance. So we're going to do it that way. So the flexible budget variance is unfavorable, and the production volume variance is favorable. So they're different signs. So when they're different signs, we're going to get a difference. So the difference in these two numbers is 10,800. The largest numbers sign is unfavorable, so we're going to bring that unfavorable right on down there. Now, just for review, let's recall how we calculated our pegs in this chart here. So the first peg in total overhead, we took peg 1 and peg 1 of variable and fixed and added them together. When you do that, you get $618,000. The second peg in total, we took the second peg of variable, the second peg of fixed to get the second peg of total. When you do that, $587,200. To get the third peg of total overhead cost, we take the third peg of variable plus the second peg of fixed. And that will give us $571,200. And the fourth peg of total overhead cost is found by taking the third peg and the third peg of variable and fixed, and that gives us $607,200. So when you check yourself here, the reason you may want to calculate these pegs is if you take the difference in pegs 1 of total and peg 2 of total, that should give you the spending variance. If you take the difference in peg 2 and peg 3, that should give you the efficiency variance. If you take the difference in peg 3 and peg 4, that should give you the production volume variance. So again, that was just another review of how to calculate our overhead variances. Now we're going to use these numbers to journalize our overhead variances. Now, using the variances that we calculated in the prior problem that we just did, we want to journalize these variances. So the first thing we want to journalize is the actual variable overhead incurred. So if you think about this, we're actually going to need an account for variable overhead actual. So we'll need a T account for that. We're also going to need an account for variable overhead allocated. So if we look down here at the bottom, I've got our calculations here. And if you look at the actual overhead, which is on the far left peg there, we found that to be $245,000. And the allocated or standard amount was $211,200. So we recall from our discussion of overhead, the overhead T account, on the left-hand side, when we used one T account, the left-hand side, the debited side, was always the actual overhead, and we always credited overhead for the allocated, what we calculated, the allocated amount. So the allocated T account will be a credit balance of $211,200. So now we need to journalize this. So typically journal entries come first, but just so you can see the picture, I wanted to do the T accounts for you. So we're going to debit variable overhead, and this would be the actual. Okay, so actual variable overhead for $245,000. And we're going to credit all kinds of accounts. It could be accounts payable or any other kind of liability for our variable overhead, whatever it happened to make it up. So that could be all kinds of different liability accounts there. Now think back. So now we want to journalize the allocation of overhead. So think back to the flow of costs when we're talking about that and how costs flow through the manufacturing process. So when we applied or allocated overhead, we debited work in process. So work in process is going to get debited for the standard amount, and we're going to credit the variable overhead allocated account for the $211,200. Now let's look at journalizing the actual variances. So following from the prior screen, we had two overhead accounts. We had a variable overhead for actual and a variable overhead for allocated. Recall that we do not want a balance in our overhead account. All that stuff needs to get expensed into cost of goods sold. So we need to get rid of both of those accounts. So variable overhead allocated had a credit balance. So to get rid of it, we have to debit variable overhead allocated. And it had a balance of $211,200. And our variable overhead actual had a debit balance. So to get rid of that, we'd have to credit variable overhead actual, and that had a balance of $245,000. Now we don't balance, and you probably already know why. We don't balance because of our variances. Both of those variances in our variable charts, if you look down here at the bottom, both of them are unfavorable. So we know that unfavorable variances make expenses increase, so make cost of goods sold go up. and cost of goods sold goes up with debits. So unfavorable variances get debited. So we have a variable overhead spending variance, which is unfavorable, at $17,800, and we have a variable overhead efficiency variance, which is also unfavorable, at $16,000. And now we should balance. Now I know that we've talked about the difference in having two overhead accounts versus one. So let's also look at, well, what if we had one overhead account? So in this case, this would be variable overhead. We know actual overhead is on the left and applied or allocated is on the right. So our actual overhead in this problem was $245,000. Applied was $211,200. So it looks like we have a debit balance of $33,800. And now you have to think, are we under or over applied? We're actually under applied because we did not apply enough cost. So I have to get rid of this overhead account that currently has a debit balance. To get rid of that, I would have to credit my variable overhead T account for that $33,800. Well, what are my debits? Well, in this case, we're just going to carry down these two variances. We're going to debit our variances. We have to record our variances. In this case, they're both debits. So variable overhead spending variance gets a debit of $17,800, and variable overhead efficiency variance is also a debit because, again, they're both unfavorable, and again, we should balance with no problem there. Now let's do the same thing with fixed overhead costs. So we have, the first thing we want to do is journalize the actual fixed overhead cost. So our actual fixed overhead will get debited. So fixed overhead was $373,000, so that was our first peg there. And we're going to credit, again, all kinds of accounts may be credited here. For example, rent payable on our factory might be a credit. Accumulated depreciation on our equipment in the factory might get credited. But they would need to all add up to this $373,000 in actual fixed overhead. Now let's talk about the allocation of the fixed overhead. Just like with variable, when we allocated overhead, we allocated it, it went into work in process. So we're going to debit work in process for the allocated amount, which is that third peg, $396,000. And we're going to credit our fixed overhead allocated amount, $396,000. So again, we could have our fixed overhead actual account and our fixed overhead allocated account if you're using two overhead accounts for fixed like we did for variable. And again, on the next screen, I'll show you, just like I did with variable, the difference in using two fixed overhead accounts versus one when we're recording those variances. So now we want to record the fixed overhead variances. So if you remember from the prior screen, we had two overhead accounts. We had fixed overhead allocated and fixed overhead actual. Again, just like with variable, we don't want to have a balance in these accounts, so we need to get rid of them. Fixed overhead allocated had a credit balance. So to get rid of that, I would have to debit fixed overhead allocated for the balance, and it was $396,000. And fixed overhead actual carried a debit balance. So to get rid of that, I would have to credit fixed overhead actual, and its balance was $373,000. So we've closed those accounts out, but again, we don't balance, and we know why. We've got to journalize these variances down here. So we have differing signs this time. One is unfavorable, one is favorable. So we know that one's going to get a debit and one's going to get credited. We know that unfavorable increased cost of goods sold. Cost of goods sold being an expense account increases with a debit. So we're going to debit the fixed overhead spending variance, and that was for $13,000. And we're going to credit the fixed overhead production volume variance, and that was $36,000. And we should now balance. Now again, that was using 2 fixed overhead accounts. Well, what if we're only using 1? So then we would have fixed overhead in 1T account. Again, the left would be actual fixed overhead, the right would be applied or allocated fixed overhead. Our actual fixed overhead was $373,000. Our applied or allocated was $396,000. So in this case, we end up with a credit balance. So we're actually over applied now. We applied too much fixed cost. So we need to get rid of this. So to get rid of a credit balance, we would have to debit fixed overhead. And the balance was $23,000, so I need to get rid of that. And now I would need to journalize my variances just like I did up here. So I'm just going to move those down just like I did up there. So I have a debit to fixed overhead spending variance of $13,000 and a credit to the fixed overhead production volume variance of $36,000. And we now balance just as we did in the prior journal entry.